Every single company out there, from your local coffee shop all the way up to a massive global tech giant, has to answer the same big question. How do we pay for all this stuff? Do they sell off pieces of ownership, that's what we call equity, or do they go out and borrow money, which we call debt? Well, today we are diving into a Nobel Prize-winning theory that completely flipped our understanding of that choice on its head.
Yeah, just think about that for a second. What if, under some very specific, ideal conditions, that choice between debt and equity is totally irrelevant to a company's actual worth? It's a shocking idea, right? It feels completely counterintuitive. But that's the core of the Modigliani-Miller Theorem, and understanding it is the secret to figuring out how companies really create value.
So, before 1958, corporate finance was, it was a bit of a guessing game. It felt more like an art than a science. The conventional wisdom, the thing everyone just knew, was that there had to be some kind of magical, perfect recipe, the optimal mix of debt and equity, that would make a company as valuable as possible. But then, two economists, Franco Modigliani and Merton Miller, showed up and basically said, hold on, what if you're all wrong? To prove their point, Modigliani and Miller, we'll just call them MM from now on, did something brilliant. They asked us all to imagine a perfect world for just a moment, a world without all the messy, complicated stuff we deal with in reality. In this perfect capital market, they could finally isolate the true effect of a company's financing decisions. So what does this perfect world look like? Well, for starters, there are no taxes. None. Imagine that. There are no fees for buying or selling stocks. And if a company happens to go bankrupt, it doesn't cost a thing. And here's the really important part. Everybody has the exact same information. And everyone, you, me, the big corporations, can all borrow money at the exact same interest rate. By setting up this perfect little sandbox, they could see what was really going on. And that set the stage for their first huge reveal.
And here it is, their first bombshell, the capital structure irrelevance principle. It basically says that the value of a company with a ton of debt is exactly the same as an identical company with no debt at all. The big idea here is this. Think of a company's value as a pie. The size of that pie comes from its assets, its operations, its ability to make money. In this perfect world, MM argued, how you slice that pie between the lenders and the owners doesn't change the size of the pie one bit.
Okay, hold on. I know what you're thinking. But wait a second. Isn't debt supposed to be cheaper than equity? We hear that all the time, right? So how could adding a cheaper ingredient not make the whole thing more valuable? Well, this is where the genius of MM really shines through. And it all comes down to a super powerful force in the market called arbitrage. To see how this works, let's picture two companies that are perfect twins, Firm A and Firm B. They have the same factories, sell the same stuff, make the exact same profit. The only thing that's different is how they're paid for. Firm A is 100% owned by shareholders, all equity. Firm B is 50-50, half equity, half debt. MM's big claim was that in a perfect market, these two firms have to be worth the exact same amount. And here's why. If the company with debt, Firm B, was somehow worth more, a smart investor like you could swoop in and make a guaranteed, risk-free profit. You'd sell your shares in the overpriced Firm B, take that money and buy shares in the all-equity Firm A, and then, and this is the secret sauce, you'd go to the bank and take out a personal loan to perfectly copy the debt that Firm B had. They call this homemade leverage. And what's the result? You get the exact same cash flow, the same return, but for less money up front. And because there's no such thing as a free lunch in finance, investors would stampede to do this, selling B and buying A, until their values were forced to be exactly the same.
Okay, so in a perfect little thought experiment bubble, how you pay for things doesn't matter. It's elegant, it's beautiful, but we don't live in that bubble, do we? So let's start popping it. Let's crash this beautiful theory into the real world by adding the first and maybe the biggest market friction of all, taxes.
And this is where debt suddenly gets very, very interesting. See, in most countries, when a company pays interest on its loans, it can deduct that interest from its taxable income. But the money it pays to shareholders, dividends, is not deductible. This creates this amazing thing called the interest tax shield. Essentially, for every dollar a company pays in interest, it reduces its tax bill. That's less money for the government and more money left in the pot for the investors.
Now, Modigliani and Miller saw this, of course. So in 1963, they updated their own theory. The new and improved equation says that the value of the company with leverage is equal to the value of the unleveraged company plus the present value of all those future tax savings. All of a sudden, debt isn't just about slicing the pie anymore. The tax shield is literally making the whole pie bigger.
So, if every single dollar of debt you add makes the pie bigger because of these tax savings, what's the logical conclusion here? Right. A company should pile on as much debt as it possibly can. It should be 100% debt financed to be worth the most. But just look around. That's clearly not what's happening. No major companies are 100% debt, so something else must be going on. There's got to be a downside, right? And there absolutely is. While that tax shield is a nice benefit, piling on too much debt unleashes a really powerful and dangerous counterforce, what we call the costs of financial distress. This is the risk that a company won't be able to make its payments, and that risk can get very, very expensive very fast. And I'm not just talking about the obvious stuff, like paying lawyers if you actually go into bankruptcy. Nope, the real damage, the stuff that really hurts a company, are the indirect costs that start to creep in long before that. Your customers get nervous. They wonder if you'll be around to support the product next year, so they stop buying. Your best employees see the writing on the wall and start polishing their resumes. The company gets so laser-focused on just surviving day to day that it starts passing up perfectly good, profitable new projects. These hidden costs start to shrink that pie. So now we have these two huge forces pulling in opposite directions. On one side, you've got the tax shield whispering, hey, debt is great, it saves you money. And on the other side, you've got the costs of financial distress screaming, whoa, be careful, too much debt is terrifying. And pretty much all of modern finance is about trying to find the perfect balance between those two.
This brings us right to what we now call the trade-off theory, which is a direct descendant of MM's work. It says that companies are constantly trying to trade off the benefits of debt against its costs. The perfect, optimal capital structure, that sweet spot, is the point where the benefit you get from adding just one more dollar of debt is perfectly canceled out by the increased risk and cost that comes along with it.
Now, the trade-off theory is hugely influential, but it's not the only game in town. There's another compelling idea called the Pecking Order Theory. This one focuses more on what managers actually do. It says that managers know more about the company's real health than outsiders do, so they have a preferred order for raising cash. First, they'll always use the profits the company has already made. If that's not enough, they'll issue debt, and only when they have absolutely no other choice will they issue new stock, because doing that can send a signal to the market that they think their stock is overpriced.
So at this point, you might be thinking, okay, the original theory was wrong because it ignored taxes and bankruptcy. And you know what? You'd be absolutely right. But that's the paradox. That's exactly why the theory is so brilliant, and why Modigliani and Miller's work is still the absolute cornerstone of modern corporate finance.
Here's why it's still so critical. First, it's our baseline. It's the starting point for every conversation. Second, it forces us to be specific. If we want to argue that financing does matter, MM's theory makes us point to the exact real-world friction, like taxes or bankruptcy costs or that information gap that's causing it. And maybe the most revolutionary thing it did was teach us to separate a company's investment decisions from its financing decisions. That was huge. It meant managers could focus on finding great projects first and worry about how to pay for them later.
And it all comes down to this one powerful takeaway. The real job of a great manager isn't to be some financial wizard cleverly slicing up the company's value pie. No, the real job is to focus on the actual business, the great ideas, the efficient operations, the happy customers, all the things that make the pie bigger for everyone in the first place. Which leaves us with this final crucial thought. If, in a perfect world, capital structure is just a detail, then what truly creates value? And the answer, the one that Modigliani and Miller really helped us see clearly, isn't found in a spreadsheet about debt ratios. It's found in what the company actually does. The real value comes from innovation, from strategy, and from execution. And that's the MM theorem explained.